Good afternoon, everyone. As we've talked about before, this video is intended to be a substitute for our class, typically held on Friday. You will find that this video comes live right at the beginning of our usual start time, so at noon, and that as soon as this video ends, there will be a timed quiz on Moodle. And that quiz is intended to be very short and relatively easy to do, so long as you have watched the video and taken some notes as you would normally in class. During our class session today, then we'll spend the majority of our time covering the problem set 3, but we'll also, if we have enough time, talk a little bit about ideas in Chapter 8. Let's bear in mind that coming in next week, we are going to move into exam review and the exam itself. So I have pulled up here your Moodle page, and you will find that down here in our current unit in the class, we have our exam review sheet and the exam 2 equation sheet here. These are good resources for you to use to prepare for exam review on Monday. Also, I want to remind you one more time about the Set Your Target Scores assignment in here. Again, it's been shown that setting a target grade for an exam is a great way of improving one's performance. It seems like students who are asked to set a particular objective and measurable goal tend to perform better. And so I encourage you to please go in here, download this spreadsheet, put in your name, your exam 1 score, and then your targets for next week's exam and then your final exam. Again, this exercise is really valuable, even if you haven't consented to be a part of the experimental investigation. This exercise in goal setting is really, really valuable, and I encourage all students to do so. All right, so let's go ahead and get started. I have here your problem set 3 guiding document. We have 4 questions here of varying length and difficulty, and we have 2 ways of submitting our assignment. Again, by now you've either A, put a digital submission in the Dropbox, or B, brought a paper copy by Dawn's office in 238. From here on out, as we go forward, I'll be covering these problem sets. Given that we're going to do this through the screencast, I'm going to work out these problems through an Excel template here, whereas many of you might have chosen very reasonably to do this problem by hand. Many of these problems are, we'll see, very process related. So I will be doing here in a spreadsheet this material, but you might have chosen to do it by hand using your financial calculator. Nothing wrong with that approach. And in fact, given the kind of nature of these problems, it's probably, for some of you, a preferred approach. In either case, whether you use Excel or you use a paper copy, to submit your assignments, you really want to make sure that I can trace your work, that I know where your answers are coming from. All right, let's go ahead and get started. So on the Moodle page, there will be a quiz that will follow up in this area. That will pop up after this, and there will also be the completed spreadsheet for you to take a look at to kind of verify your work. All right, let's take a look at problem number 1 here. The last dividend of the common stock for this company was $2.50 per share. Suppose that the expected growth rate for the next 2 periods is 18% and then 5% indefinitely after that, and that you require a 15% return for assets like this. Unnecessary question mark there. Draw a timeline for this stock over 3 years and label the cash flows. Let's start with that piece. All right, we've got a growth rate that persists for the next 2 periods, 2 periods. After that, dividends grow at the lower growth rate indefinitely. You can see here that I've taken an effort to pull some of this information out to the side. Please note that the dividend listed here, this kind of language here, implies that this was the current dividend or the past dividend, time period 0. All right, so that's our D0. After that, we have a year of growth at which we'll see dividends grow at 18%, and that will help us find D1, and then grow again at 18%, and that will help us find D2. So let's go ahead and then we'll find D3 as well, where here we'll have to be careful that we look at D3, paying attention to the fact that that new growth rate has kicked in. All right, D1 then is going to be equal to my D0 grown by 1 period. So here I'm going to say 1 plus my first growth rate, which is this 18%. There's an implied power of 1 here. What do I get? I get a dividend of $2.95. The same thing then for D2, where I can do one of two things. I could grow D0 2 periods, or I could take D1 and grow it 1 period. So I'm going to multiply this by 1 plus my growth rate here. All right, and again, there's an implied power of 1 there. And now I've got my dividend in period 2. And then D3, well, if I want to find D3, now I need to be careful. I can't take D0 and grow it 3 periods. I've got one growth rate that takes me up to time period 2, and a new growth rate that grows D2 to be D3. So I have to do this the one-off kind of way, in which I say, well, D3 is equal to D2 multiplied by 1 plus the growth rate, where that growth rate is now G2, my growth rate thereafter. All right, so I see I left a multiplication there, an asterisk out there. All right, so now I will have my D3. Okay, so we go back to the assignment, and I ask you in step A, draw the timeline, label the cash flows. Okay, done. I ask you in part B, what are the dividends paid in each of the next 3 years? I've now got that. In step C, what is the expected stock price in year 2? This is a place where we want to be really careful. I have in steps A, B, and C very carefully, very explicitly walked you through the process of setting up the answer to step D. All of these are intermediate steps, if you ask me, to answering this question in part D. If you think about this, then you can imagine a question on a homework, an exam, or a quiz where I don't give you steps A, B, or C, and I just say, find a value of this company's stock. Right? This is a chapter on valuation. Find the value of this company's stock. You have to know how to approach this question. And one of the key sticking points for students is often, when do I look at this terminal price, as it's often referred? I think this is why the timeline is so important. If you look at our timeline, you can see that we get to time period 2, and it's there that this new growth rate kicks in, a growth rate of 5%. All right, and so we want to think about, well, I can find P2 because it is a function of all of the future dividends that come after period 2, where I know they're going to grow by 5% every single period thereafter. So if I want to find P2, I'm going to use my constant dividend growth model formula here. So if I want to find P2, I'm going to say, well, this is equal to D3 divided by the difference between my equity cost of capital and the growth rate. Where here's another common misstep. That growth rate is the second growth rate, the one that will persist forever after. All right, now I've got my growth rate I've got my price at time period 2, reflecting the fact that I expect these dividends to grow at 5% forever. Now I'm ready to answer this question in part D. What is the value of this company's stock? Well, the value of this company's stock in any of these dividend discount model approaches is the present value of those future cash flows that are expected. Now, we've taken all the cash flows from time period 3 on and accounted for them in P2. But we do have 2 other cash flows to account for. So here I want to say the present value of this dividend. Okay, I'm going to say the dividend times my interest, my discount factor, which is 1 over 1 plus the growth rate. The required rate of return on the stock. And then here's the important piece. I'm going to raise that to the power of 1, right? Because I'm only discounting this back 1 term. All right. And so doing that, then you find the present value of that dividend. Again, if you're doing this by hand or even with your financial calculator, you're getting slightly different answers because of the rounding that's occurring. Excel is holding on to fractions of a penny here. Okay, now I want to do the same thing for D2 and for P2, but I've got to keep in mind that now I'm discounting this cash flow back 2 periods. So for D2 then, I'm going to multiply this by my discount factor, which is 1 over. You could also think about this as dividing by the interest factor. We're going to multiply this by the discount factor of 1 plus the required rate of return, where now I'm going to raise that to the power of 2, because I'm looking at the present value of a cash flow that's 2 periods in the future. So I've got to scoot this cash flow back 2 periods. There I'm able to find the present value of those cash flows. I need to do the same thing for P2. Now, in terms of your process, you might have added these 2 cash flows together, D2 and P2, and then discounted that one value all the way back. That would be fine. Since they're going back the same number of periods, the present value is the same. My approach here is going to be to find the present value of each individual cash flow, and then after that, we can take the sum of the present values. Either approach is fine. This one does require this one extra step of multiplying by the discount factor, an extra time here. So again, it's 1 plus the required rate of return, or the equity cost of capital. Again, I am going to raise that to the power of 2. All right. But there is my present value of those cash flows. Now, the share price today is just equal to the sum of each of these terms in this array. So you can see there what I've just done is to say take the sum of all of the values between D17 and D19. I hit enter. There's my share price today. Again, you might have something notably different because of rounding. If I tell Excel to treat all of these as cash, right, it rounds them to the nearest penny. The point is still the same. That, or when you're doing this on your calculator, you might have done some rounding at each step. The point that's relevant here is that you need to make sure that I can see what you did. I need to be able to see your steps here. If you get something wrong, a minor error, I can still award partial credit as long as I can see where that error came in. Anyway, our current price for this stock should be in the neighborhood of $32.83, reflecting the present value of the future cash flows. A common question here is, why didn't we have to discount dividend 3? The answer to that is that, well, we did. We discounted dividend 3 and dividend 4 and dividend 5 and dividend 578. We discounted this infinite stream of growing cash flows when we found P2. Once we get that cash flow occurs at time period 2, we've got to bump that back to today. So we have accounted for D3 and D4 and so on. We've done so by calculating P2. To discount P3 back separately and treat it as another cash flow would be to count that dividend twice. All right. As I think about your questions for our quiz thereafter, I want to make sure that I incentivize paying close attention to this, and so I'm going to tell you that my daughter went to school today dressed as Catboy. That will be an important answer for your quiz. Okay, so as we look forward then, we're now ready to move on to problem 2. Okay, in here we have a bond problem. Consider 2 bonds, one with a coupon rate of 4%, semi-annual coupons, and 10 years to maturity. The second bond has 5 years to maturity, but is otherwise the same. What is the most you should pay for each asset if current yields are 6%? And then you'll notice in step B, I ask you, do the bonds sell at a premium or a discount? I really want to encourage you to get into the habit of thinking and planning about problems before you just jump in and start solving them. I know it's really tempting to say, I know there's a formula for this, let me start turning the crank. However, it's easy to make some slip-ups in here, and if we don't think carefully about what we expect the answer to be, we won't know if we've gotten it wrong or right. So let's think about this problem. Bonds that are selling today, in this example, are selling at face value. So that's $100 per $100 of par value. they are selling at face value with coupon rates of 6% that are set equal then to the yield of 6%. Right? That's what it takes for a bond to sell at face value. The yield must equal the coupon rate. Okay, what must it mean then if I have this old bond out here at 4%? What must be true? Well, if what I want is to think about how I can get an investor to buy my bond that's only offering 4%, I'm going to have to sell that bond at a discount in order to get people to be willing to buy it. Because if I wanted to charge face value, well, if they go out and buy a bond at face value today, they might as well buy current bonds that are going to get them 6%. So we should expect that the answers to these questions, as we look at the most you should pay, the current price, we should expect these bonds to sell at less than $100 of face value, sell at a discount. So even though I don't ask you about that until step B, you should probably get into the habit of planning so that you know that you have a particular answer you're expecting. All right, let's get to work here. Effectively, this is a present value problem where we need to think carefully about a couple of things. All right. So, for example, first of all, I tell you that these are semi-annual coupons. I tell you that current yields are 6%. I tell you that the bonds have 5 and 10 years to maturity, depending on the bond. Let's think carefully about this. So let's first do the 10-year bond, all right, and find its price. Well, I want to find the present value of this. Effectively, the bond's price is a representation of the present value of the bond given these things. Let's think about this rate. First of all, it's not going to be the coupon rate. Hopefully we're past that. We're comfortable understanding that the rate I'm looking at here is the yield. What's important to remember is that our yields are quoted annually. That's going to matter in a later problem as well. So if our yields are quoted annually, when I put this problem set this problem up, the information I need, don't forget that Excel wants your rates as percents, I'm going to need to divide that by 2 to get my period-specific rate. Similarly, when I calculate my number of periods, or enter in my number of periods, I've got 10 years for my 10-year bond, but it's semi-annual, so I have 10 times 2, I have 20 periods. When I go calculate my payment, well, the coupon rate is 4%. So we're going to do this problem per $100 of face value. So if you're thinking about the calculation we've done so often, we're going to say, well, I want my coupon payment, where that is 4% times 100% of face value, $100 of face value. So there's 4 divided by 2, semi-annual. So my coupon payment here is 2%. My future value, well, there's my $100 at maturity, or per $100 of face value. Solve the problem there, we get a bond price of $85.12. All right, notice that it's negative, reflecting that this is a cash outflow. All right, so let's pick up with our calculation here. Same thing as before. We are going to say that the present value of this bond, its current price, is a function of, well, first our yield, where we've got to make that period specific. Now our rate function is asking for a number, our present value function is asking for a number of periods. That's where 5 times 2, 5 years times 2 payments per year comes in, and we have a number of periods that is 10. Our payment has not changed, still $2. And then finally, we will put in our $100 of face value as our future value. And as a result, we get a bond price of $91.47. You'll notice that as we take this same bond and we move it towards maturity, the discount is going away. We're seeing that the bond price is approaching face value as we approach maturity. So that allows us to talk a little bit about this question here. We know that this bond is going to sell at a discount. We talked about that at the outset of this problem. What we can see is that we have a decreasing discount as we move towards face value. As we move towards maturity. Okay, now this question asks, well, what happens if yields change? Again, we'll do this for our 10-year bond first, and we will go grab, I'm going to grab the formula here. Everything is the same except for one piece, and I'm going to stick it in here. There's no reason you couldn't just type all of this in. And now I'm going to change this to 7%. If you're doing your financial calculator, you can leave the keys alone and just go and leave the keys defined as they are, and just go change that one key, that rate, and put in the 3.5% here that you will see, and recalculate the present value, and it'll redo that calculation for you. So here we get a bond price of $78.68. I want to do the same thing again for my 5-year bond. All right. So I'm going to come down here. I'm going to say, well, for my 5-year bond, everything is the same as it was before, but the rate is different. And as a result, we get a new bond price of $87. Again, the discount is decreasing as we go forward in time, or rather as this bond approaches maturity. Now there's this question: which bond is more sensitive to yield changes? Again, we need to be able to think about why this might be true. Right? This long-term bond is selling at a deeper discount than the shorter-term bond, reflecting the fact that this gap between the coupon rate and current yields is going to be, in effect, is going to impact my returns for a longer period of time. That should tell us already something about sensitivity. But we did give ourselves the means of calculating this in class. We said, well, what's the percentage change? So I'm going to say, well, I want to take my new price minus my old price and divide that by my original price. And this will give me a percentage change, where you can see it's trying to hold on to that dollar value for me. This is a percent change, and give myself back a couple of decimal places, and you can get a more accurate answer for this percentage change. All right, so we have a negative 7.5, nearly 7.6% change in prices, reflecting this change in bond prices to changes in current yields. Let's do the same thing here, and since I've got this set up calling upon cells here, I can just go back to this and click and drag over, and it's going to repeat that calculation for me, showing a bond sensitivity of 4.3%. So finding that percentage change is allowing me to quantify sensitivity. And again, it's in here that you can say now specifically this 10-year bond, the longer maturity bond, is more sensitive to yield fluctuations. And you can say that you've calculated it, you can demonstrate that that's true, but you also want to be able to talk about the exposure to this gap between coupon rates and yields over time. All right. Another way of thinking about this is that I have a stream of cash flows that are out there that are being discounted back at that new yield, right? And as a result, those further out cash flows and that larger number of further out cash flows, their present values are going to fluctuate quite a bit as the yields I'm using to discount them are changing. So another way of thinking about the same thing. Right, next we can move into what is probably everybody's favorite assignment, part of this assignment, and that is the yield calculations for a series of different bonds. The reality is I've given you bond prices for 3 bonds in 2 circumstances. What if there were a recession, and what if there were not a recession? Some things to think about right away. So how am I going to calculate these yields? Well, these are really rate problems. In the information I give you, we have semi-annual coupon payments. Okay, I've got my payment. I got my years to maturity, and we know it's semi-annual, so I can get my N there, no problem. 10 times 2 is 20. We can see that these prices, they sure look like they're per $100 of face value, so there's our future value there as well. There's our future value of the 100, and these prices are our present value. And so the only key we don't have is our interest rate or yield or rate calculations, as we'll see in the context of Excel. So I ask you here very specifically for annual yields for each bond in each period. That means we're going to need to do 6 calculations. All right, so going over to my Excel template, I've got all of this information put in. I again want to think about this as a rate calculation. All right, I've got my number of periods. Again, that's going to be 10 times 2, that's going to be 20. I give you the semi-annual coupon payment. They're the $250, so you're not expected to calculate that here. I give you the present value, and here's where a really important stumbling block comes in. These, as we saw in the previous problem, need to be treated as cash outflows. So I've put a negative sign here showing that the current price would be me buying this bond, and this would be a cash outflow. My future value, that's that $100 at maturity that I would expect. Right, and hit enter, and it's going to calculate this rate for us. At this point, it's important to make sure that we get our setup correct here. So let's go ahead and give ourselves these decimal places to be able to observe these rates. Now, an important bit here, and you can see I've got this baked into the setup of my template. This rate is period specific, where we took pains to make adjustments to our N multiplied by 2 to make sure our coupon payments were semi-annual, and and therefore, when we think about the yield we've just calculated, it is, in quotes, period specific as well, which is to say that it's a 6-month yield. We need then to double that to get our annual yield. Okay, so now we've got an annual yield that tells us about the yield on this bond. Now, a great thing about this, everything I've entered in here, except for the bond price, is stated numerically here. It means that when I go through and I repeat this formula, I can just click and drag, and it's going to repeat those calculations, grabbing the data from the appropriate field. I can do the same thing then for my annualization, for my multiply by 2. I can come over here, I can grab this entire column and say, hey, do the same thing in this column, and I get my yield for these new prices. You'll notice if I click on this cell, it's done the rate function calculation again, but it's grabbed C8 instead of B8, and it's calculated that new rate given this new bond price. So that's one of the really great things about Excel. It can do this for you really quickly. All right, I'm going to ask the same thing here. I'm just multiplying by 2 for each of these. So I've got my 1.9 gives me 3.8. I've got my 2.4 every 6 months giving me 4.8. So these annual yields are really APRs, right? We've just multiplied by 2. Okay, not too bad. I want to think a little bit about a couple of these things. We go into a recession, and we talked about these in class. We talked about yield spreads, the spread between risky bonds, bonds with at least some amount of credit risk or default risk, and the difference between the yields of those bonds and our U.S. Treasury bills and notes and bonds that are treated as risk-free. Think about what happens here as we go into a recession. It's what we saw in class. We saw that risky bonds, and our triple B here is our most risky bond of the 3 of these. We saw that yields tend to tick up. Well, bond prices and yields are inversely related. So when I built this problem, I gave decreasing prices for these bonds, showing that as a result, then you see their yields going up. A nice intuitive way of thinking about this. We go into a recession, people are moving away from these bonds because they want to move to safety. They want to find bonds that are a safer bet. So they are moving out of this market and they are moving into this market. So you can think about them selling these bonds now. They are increasing the supply of these bonds. And when you increase the supply of something, the price goes down. So we see decreases in prices here that drive up yields down here. Then you look at the market for the T-note, particularly through the price, you see that the bond price has actually gone up. People are rushing out to our safer bonds and buying them, and they are bidding up the price. Increase in demand increases price. Well, that shows up then as a decrease in yields. Okay, now I have my 6 yields that were semi-annual, made annual, and now I'm asked to calculate the annual yield spreads. There's a reminder even there. Hey, pay attention, this needs to be annual. Between these assets and the T-note in each period. So in one case, I'm going to say, well, my AAA, so we'll say this cell is equal to my AAA minus my T-note. All right, and the spread there then is 0.5%. If I move it over, then I calculate the spread for that same bond when there is a recession. You'll notice that the spread increases. If I do the same thing for my triple B bond, these are my riskier bonds compared to my triple A. As a result, the spread should be even higher. So we are going to take the difference between our triple B yield and our T-note yield and find it as 1.2. And then in a recession, it is 2.2. Those increasing yields then reflect this, the financial market pricing in a higher expectation of risk. So these are the answers to this question, part B, particularly in which you are asked to calculate these yields. Hopefully you can see these in the context of what we talked about in class with spreads fluctuating as we move through economic cycles. All right, moving on then to question 4. It's in this question that we are asked to talk a little bit about our dividend discount model given some growth. If we look at this, Simpson Pharmaceuticals is considering developing a vaccine. I give you some information about what it's like for this firm before you develop the vaccine. Earnings were $2.10 per share, so that's EPS 0. We have some kind of expected growth rate of 5%, and dividends are 80% of earnings. The payout ratio is 80%. Under the development plan, where I go build this new product, earnings are expected to grow by 40% per year for the next 3 years, and all earnings are retained and reinvested. Right there, I've just told you the payout ratio is 0. So even though the earnings are growing by 40%, dividends in this time period are 0. Okay, 3 periods of growth followed by a kind of return to normalcy. Growth is going to drop to 5% and stay that way forever. As soon as you see constant perpetual growth, you should be thinking about that constant growth rate model for the dividend discount model. At this time, then, Simpson will kind of return to its normal habit of paying out 80% of earnings as dividends. I give you the equity cost of capital, and I ask you to calculate the value of the share with and without the development of the vaccine. Okay, so if we think about all of those pieces, I've asked you for two key things here, a share price with and a share price without the vaccine. I grab out all of my relevant information, and you can see here that even though the question doesn't ask me to, I have very carefully laid out my timeline. Without the investment in the new product, we can think about my current earnings, what future earnings might look like given my original growth rate, and then use that to think about dividends, and then therefore think about a share price. First step is finding those earnings. If you think about our constant dividend growth model, we need, if we want to find P0, we need D1, and then we'll divide that by the difference between our equity cost of capital and the growth rate. To find D1, we first need our earnings per share in time period 1. So let's start there. We're going to say that earnings per share in time period 1 is equal to my earnings per share in time period 0, current earnings per share, multiplied by 1 plus the growth rate, and this is implicitly raised to the power of 1, grown for 1 period. And there are my earnings per share in period 1. However, I'm not getting paid all of that money. Right? I'm getting a dividend that is 80% of that. So D1 is equal to my earnings per share multiplied by that payout ratio. And there are my dividends per share. Now I can calculate my share price by taking D1, dividing it by the difference between my equity cost of capital and my growth rate, and that gets me a share price, $22.05 and 20 cents. All right, where that share price reflects this assumption of constant and perpetual growth at 5% forever. Okay, what about with the growth plan? This is where we've got to think really carefully. So again, I've developed my timeline here. I've got current earnings, and I'm told that in the next 3 periods, earnings are going to grow at this very high rate of 40%. And then after that point, we'll return to a growth rate of 5%, but it's only then that we'll get a dividend. So here's where we need to be a little bit careful, right? We don't have cash flows in these periods. We only have earnings that are not paid out. The payout ratio is effectively 0. So this is where we need to think really carefully about our approach to this problem. All right, we are going to want to find D4. How are we going to find D4? Well, first of all, we know that D4 is 80% of earnings per share 4. How are we going to find earnings per share in time period 4? Well, we know that earnings per share is going to grow in a very specific way over the next few years, where over the 3 years, I'm going to get this very high growth rate of 40%, but after that, a new growth rate of 5% is the norm. So it's not enough for me to just grow 2.10, $2.10 for 4 periods at 40%, because I have to account for this change in growth rates. I can, however, get my earnings per share 3 by saying, well, that is my earnings per share at time period 0 multiplied by 1 plus that new growth rate of 40%. And I'm going to raise that to the power of 3. So my earnings per share at time period 3 is a little bit more than $5.75. Okay, now I've got my earnings per share in time period 3, but what I really want is D4. How do I get D4? I get D4 by finding EPS for my earnings per share in that time period. So this is equal to my earnings per share in time period 3 multiplied by 1 plus that new norm of the 5%, and this is raised to an implied power of 1% there. It's only of 1. It's only growing 1 period. Now I've got my dividends in that. I'm sorry, my earnings in that period. My dividends are 80% of my earnings per share in that period. That means that my shareholders in time period 4 are going to receive my cash flow of $4.84. Now, why go through all this trouble? Well, the whole point of this is to put value on this company's stock, but I know I don't get dividends in this time period. In fact, the first dividend I can plan on getting is in time period 4, where I know that it's going to have this growth rate of 5% here and then forever after at 5%. That means I can find P3 using the same kind of formula we did over here. P3 then is going to take D4 and divide it by the difference between our equity cost of capital and that new growth rate. So P3 then is our $69.15. That occurs right here. Let's note that that is not then in present value. We need to discount that back to today. So we have P3 representing the value of all future cash flows I will get, where those cash flows were determined by, yes, this growth rate, G1 or 5%, but also that 40% that occurred through here, even though we didn't get dividends. Right? We only were able to find this dividend given the growth that occurred in previous periods. All right, so P0 is this single cash flow discounted back, so I'm going to multiply by my discount factor of 1 plus my required rate of return. And I'm discounting that back. This is P3, so I'm discounting this back 3 periods, back to time period 0, back to today. This then is our share price for this company's stock under the new assumption of 40%, under this new growth plan, given the development of this new product line. What you can see is that investing in the firm, even though I don't get dividends in this period, investing in this new product line substantially increases shareholder wealth. Without the product, a new product, my shareholder value is $25 per share, reflecting all future cash flows given that flat growth rate of 5%. Given this period of very strong growth before returning to normal, the share price is significantly higher. We saw similar problems like this in class, where we talked about profitable or not profitable growth. It's also worth mentioning that originally this problem in the first draft, before I assigned you this assignment, included a part of the problem where we would find this growth rate of 40%. One of the things we did in this chapter is determining growth rates based on the investment in some new product, where that was the growth rate is equal to the return on that new investment multiplied by the retention ratio. So that was originally a part of this problem. I decided that your homework assignment was probably long enough and pulled that out, but it's worth noting so that when you go and do this work later, you're prepared to think about those kinds of problems as well. Okay, so now we have answered all of the questions in our homework assignment. The remainder of this video will be devoted to covering a little bit of content in Chapter 8 before leaving you time to complete your quiz. Okay, so now that we've completed our homework assignment, we can turn our attention back to the content in Chapter 8. If you recall where we left off last time, we had walked through a sample problem looking at the net present value rule, particularly for a project with a timeline like this, where we have an initial cash outflow of $81.6 million and then subsequent cash inflows of $28 million. Thinking about this in the context of our traditional time value of money problem, this piece over here is really an annuity. All right, so the present value of the benefits is our typical annuity formula. Our costs are already in present value, current dollars. We can then use the annuity formula to think about this piece as something that depends on or is a function of R. We took it aside and we said, okay, I can plug in 10% there and solve for the present value of that annuity and therefore the net present value. Got something like $7.2 million. However, leaving it in this way as a function of R allows us to think about the net present value profile. The net present value then very clearly depends on the cost of capital. The net present value profile is going to allow us to look at net present value over a range of different costs of capital or discount rates. What we can see here is that based on this data that we have, the net present value is only positive when discount rates are less than 14%. So this then is our net present value profile. It gives us different values for the net present value according to different discount rates. We can see that there is one discount rate at which the net present value profile crosses the horizontal axis, or one discount rate that sets the present value of the benefits and the costs equal to 0. This idea is our internal rate of return. We mentioned this very briefly in class the other day. This internal rate of return is a rate problem that sets equal the present value of some initial cash flow, in this case cash outflow, and equal to the present value of any subsequent cash flows that come in the future. We've done this before back in chapters 3 and 4 when solving for the rate, but particularly when looking at bonds, this is our yield to maturity. You just had oh so much fun in your problem set solving for yield to maturities, where you use that price as a part of the equation. This is the same thing, where the price in this context is really this initial cash flow of this $81.6 million. Okay, so we've seen this concept before. It's solving for a rate. It's really just a rate problem. In this context, it's internal rate of return. All right, so here is one of our key points, the cost of capital. When the cost of capital is 10%, the net present value is this $7.2 million. We could use this net present value profile to do some sensitivity analysis to think, what if my discount rate, my cost of capital, is as low as 8%? Well, hey, my net present value will be even higher. Or we might say, well, what if it's as high as 12%? My net present value will be even lower. We can use this kind of analysis to think about what it might be worth, what a project might be worth under different conditions. So if you're not sure about your cost of capital estimate, we can use this internal rate of return as an important tipping point. Don't go further than a place where the internal rate of return is, think about if my cost of capital might end up being 16%, I'll know that I've gone into this range where the net present value is negative. And I can think about that a possibility more concretely looking at my net present value profile, and particularly this important intersection where it crosses the horizontal axis, where that internal rate of return falls. Okay, so we've talked about it before. The net present value rule is the gold standard. However, it's worth noting that there are times in which you can't always use the net present value rule. or where the net present value rule is hard to communicate. We talked a little bit about that last time. What is the real meaning of $9 in present value? We talked about that in the context of the first problem in this chapter. So what other rules are out there? One important rule that's out there is this payback rule. This is a way of thinking about how long will it take some project to pay off its initial investment. I really think your textbook doesn't do this decision rule justice. The reality is that there are plenty of instances in which this is what I have to do. I can only, greenlight projects that I'll be able to pay back the initial investment on after some period. There are plenty of small businesses who might get loan terms structured around a certain amount of time. There are plenty of nonprofits or public sector companies, but even large corporations who are focused on a payback period because they want that liquidity piece to be addressed. When will I have my money back? Let's take a look at that problem here. Let's assume that Fredericks, this is that company with the fertilizer project, requires that all projects have a payback period of 2 years or less. Should they undertake this project? Well, if we look at our payback rule, we know that only projects in this context where the cash inflows are going to pay off that initial cash outflow in less than 2 years are going to be green-lighted. Well, I get $28 million per year, but I've got an initial investment of $81.6 million. All right, so what we can see then is that in 2 time periods, I've only paid off $56 million of the $81.6 million. And in fact, it won't be until the 3rd year that I get more than or get enough money back to pay off the entire $81.6 million. Because of this payback period, the project takes more than 2 years. Fredericks would reject the project. Again, I don't think that your textbook does this justice. They talk about this as if somehow the company is making an error looking at this. And there are limitations in here. We'll be careful about those in a moment. But if your firm's binding constraint is 2 years, then that's the reality you operate under. It doesn't matter that there are other decision rules or other projects that might be worthwhile that you're not greenlighting because of this decision rule. All right, and let's take a look at the problems here. All right, so looking at this example, here we have a company who's looking at 2 projects, and they are generally using the one that has the lowest payback period. We'll get their money back, allow them to pay off the loan faster, or get the money back in their pocket, a liquidity question, sooner. Well, if we look at these 2 projects, they each have an initial cash flow of negative $10,000. Got to invest today. Project B will pay back that $10,000 in 2 years. 5,000 times 2 is 10,000. Project A won't pay that back until 1,000 plus 1,000 is 2,000 plus 8,000 is 10,000. In year 3, Project A pays it back. But look at this whopping cash flow that comes in time period 4. If I interpret this decision rule literally, and it is a hard restriction, I'm only going to pick Project B because it pays the project back faster. Clearly there's a limitation, right? We ignore this big $1 million payout at the end. All right, so this company, given the rule we've been given, is going to pick Project B because it pays back faster. This tells us one of the key problems of the payback rule. Any cash flows that come after that tipping point, that payback period they require, they effectively have no value. They contribute nothing to our decision making. That's a real limitation. Also, the way it's presented in your text, the payback rule here ignores the time value of money. There are versions of this that account for the time value of money, so that's something to keep in mind. But as it's written here, we're not paying attention to the fact that some of these cash flows don't come for a couple of years out. We're counting $1 in 2 years as if it were worth $1 today, and that's not exactly accurate, as we've seen so many times. Okay, so one thing that's worth noting, that 4th cash flow being very high here means that the present value, the net present value, is very high in Project A, and we're missing something important if we skip over Project A for Project B. One more time, though. Your textbook, I've got language from your textbook in here that talks about arbitrary cutoffs. Let's be really careful. At your firm, that cutoff might not be arbitrary at all. It might be mandatory. It might be necessary. And I think that we shouldn't turn our nose at a rule that's used on a regular basis in industry. It does have some serious limitations, right? So first of all, it ignores the time value of money. Fair point. Again, there are versions of this rule that use that. that do account for the timing of the cash flows. It ignores any cash flows that come back after the payback period. That is absolutely true. And then finally, this decision criterion isn't grounded in economics. There's nothing in here about opportunity costs or trade-offs in here. We are just simply looking at how quickly do I get my cash back. Probably that's too narrow of a focus. What else might we look at? Well, we've already introduced this idea of the internal rate of return. How could we turn that into a decision rule? Well, the internal rate of return would tell us to, as a rule, would tell us to take any investment opportunity where that IRR exceeds the opportunity cost of capital. The IRR is nice and easy to interpret. Right? I give you a percent. Your boss will be used to interpreting percents. Okay. There are some issues in here, though. So first of all, the internal rate of return might not agree with net present value for choosing a project, particularly depending on the ordering of cash flows. We'll talk about this in just a moment. All right. And so it may be the case that the internal rate of return may disagree with the net present value. There's another important piece here that I think your textbook should emphasize. Built into the internal rate of return is what we would call a reinvestment assumption, that any cash flows I generate from this project are going to get reinvested into the project and generate the same return. For plenty of assets or projects, that might make sense, right? I might have a portfolio of assets. When they kick out income to me, dividends, let's say, I plug that dividend income back into buying assets and contributing to that portfolio. Makes sense. If the project is building a factory, it's not like every time I get revenues from the product that's sold by that factory, I can just add another 10,000 square feet to my factory, right? And so in many cases, this reinvestment assumption is a little strong. And that's something to be worthwhile to pay attention to. All right, I like this. 2001, a survey of decision rules used by people in industry, and net present value is right near the top. Internal rate of return comes out ahead, and so you can interpret this as saying the most popular decision rules for people in, this is 2001, I saw a new version of this 2015, very similar results. When they were asked to list their top 3 decision rules, 57% included the payback period, 76% included the internal rate of return, 75% included net present value. So a couple of things here. First of all, our first best net present value is on fewer people's lists, only 1 percentage point, but still fewer people's lists than internal rate of return. And payback period, the rule that we're so sure isn't appropriate or is certainly not first best, is used by 57% of people. Right? That's a pretty important decision rule pretty clearly. All right, let's take a look at our results here. From that previous project for Fredericks, we saw that the net present value is positive, accept it. We saw that the payback period is above the threshold line, that payback line, reject it. We can see that the 14% internal rate of return is greater than, in our example, the 10% cost of capital. You should greenlight the project. Again, net present value is definitely our first best for making decisions from the perspective of the firm. Let's take a look at an example that's a little bit different. Here is an athlete who's being offered 2 competing endorsements. Pick one of these 2 options. In one case, I can get $1 million up front. In the other case, I can get $500,000 in each of the next 3 years. How could we set this up for our decision rule? Well, what we've got here is an opportunity timeline that is written under the context where accepting A comes with this cash flow and comes at the cost of these cash flows, what I would have gotten if I'd accepted offer B. You can imagine the reverse of this, right? Where we give up $1 million now and get $500,000 in the future. From the context of our simple by hand calculations here, you can see that the present value of our costs, in this case, opportunity costs, are here as a function of R. Hopefully already you're thinking about that net present value profile. Our benefit is already in current dollars. Notice this is the reverse of our previous problem where we had a cash outflow and then positive cash inflows. We can set net present value equal to 0 in order to get our internal rate of return. So you can see this is just a rate problem where we have our number of periods, our present value, our payment, all right, and then no final terminal value here. Solve for the rate, you get this 23.3%. Okay, pretty straightforward, right? 23% greater than 10%, definitely should do this. All right, let's just quickly look at the net present value. what we find is that the net present value of picking option A over option B is a large negative number. You actually make yourself worse off picking the $1 million up front over the $500,000 in the next 3 months. If we look at the net present value profile, right, what we can see here is that the net present value for the project is negative at low rates of low cost of capital. And when you think about why, when those rates are low, the present value of these cash flows is going to be really, really high. Right? Imagine this discount rate was zero. $1 in the future was just as good as $1 today. We would take the sum of these, and they would each be 500,000, 500,000, 500,000, right? And you'd have a 1.5 million there. When the discount rate goes up, we're saying that future cash flows are worth less today, right? And you can think about that opportunity cost idea. I could have been earning 20%, whatever the example is. So when we have initial cash inflows and delayed cash outflows, the higher the cost of capital, the more we are devaluing those very far off cash flows. Again, that present value of the $500,000 is relatively low if our discount rate is high enough, if this denominator is large enough. So when we have this reversal of our usual format, where the initial cash flow is positive and subsequent cash flows are negative, we actually want a higher discount rate. That's going to pull down on the present value of those cash outflows in the future. Here you can see then our internal rate of return, where the net present value profile crosses over this horizontal axis, is at 23%. But if we compare that to our cost of capital, we see that the net present value is a significant and negative number. Okay, so when cash is up front, we actually prefer a high interest rate. And we can see then that our net present value rule is giving us some misleading information. Right? In the last couple of minutes here, I want to introduce you to an important idea. How might we pick between mutually exclusive projects? We can't just pick a project with a positive net present value. In general, what we should do is rank the projects by their net present value and pick the project with the highest net present value. All right, so let's say I have a piece of land, and I've been asked if I want to, if someone can buy it from me for $220,000. But you know what else? You could build a bar, a coffee shop, or a store in that same location. If we generate cash flows of this nature, our initial investment for each of these is different. Cash flows in the first year are different. We have a different growth rate, and we have a different cost of capital because these projects are associated with different levels of risk. All right. So right off the bat, hopefully, when you see a constant growth rate, an initial cash flow in time period 1, you start thinking about our growing perpetuity formula, what we did so much with our bond, with our stocks. All right. So let's look at the net present values. The net present value for the bar takes our the present value of all of those benefits and subtracts off the present value of the costs. The present value of the coffee shop, the same thing. The present value of the apparel store, once again, present value of any benefits minus the present value of the costs. Now we have their net present value. We can rank these projects according to their net present values. Selling the land is already in present value, right? $220,000. But we can see that the coffee shop has a significantly higher net present value. Right? And so as a result, with mutually exclusive projects, we should rank them according to net present value, and we should pick the project with the highest net present value. Again, you have to pick one of these projects, and doing so requires ranking them and selecting the project with the highest net present value. All right, in the last moments here in Chapter 8, I want to remind you when we come back next time, we are going to be looking at our exam review, and in there we will have to think carefully about what to include. We have not covered, for example, the modified internal rate of return. We have not looked at the crossover point. But we have talked about each of our kind of key measures of these decision rules. We've looked at the internal rate of return. We've looked at the payback period. We've looked at the net present value. Your textbook at the end does a great job of wrapping up each of these pieces by covering some of these kinds of things. laying out the advantages and the disadvantages in here. I encourage you to look closely at these tables as a way of making sure that you are familiar with the relative strengths of each of our rules. It'll be here that we stop in new material. The video is coming in just under an hour. That should leave you plenty of time to take your quiz that's going to open up immediately hereafter on Moodle. A very brief quiz that relates to some of the content we've covered today. Otherwise, I will see you all on Monday. We will pick up our exam review. Have a great weekend.